So you gotta always let the trades come to you at always the best possible price, or simply no trade. Okay, nothing, no trade at all. Okay. Rushing into your trades will create mistakes and will lower your success rate and affect your psychology, of course. Okay, so even if you have the risk of not entering in the trade because the best possible price was not met, was not touched, okay, it's better to not be in the trade than to try to enter at a price that is not the best possible price, not the optimal price to enter. Okay. Why? Because you're putting more risk in your trading, you're putting more risk in your success rate. By having less trades and having always the best possible price, you will definitely have a higher success rate. You will do less trade, okay, but your trades will work most of the time and they will be better quality, and basically this will affect your psychology positively because you're winning, you're growing your account, you're not in huge drawdowns, you're not in a streak of losing trades, so your psychology is going to be great. You're going to be creating a positive momentum. Okay, if you rush into trades, okay, you will do mistakes. Okay, you will lower your success rate. It will affect your confidence in your trading. Okay, and then it will affect your psychology, and it will create some negative momentum. And then you might see yourself after maybe a losing streak trying to gain back your losses, and trying to basically not following your rules, not following your trading plan, going just with your feeling, and trying to try anything to get your money back. And that's basically why your psychology will fail you, and usually that ends up badly. You will end up blowing your account, and I'm sure most of you guys have experienced this in the past. So basically the goal is to prevent that whole cycle and to always make sure you get the best trades at the best price. Okay, to make sure you're confident in your trade because you have a high success rate, and in turn it's going to affect your psychology positively, and you will be having a good momentum, and it will help you last longer, basically repeat that pattern on a longer time frame basically. Okay, and one important thing with the best possible price is it's not always the last price. Okay, so basically, let's say I'm looking for a long on this trade. Okay, and I have multiple levels that could be interesting. Maybe I have the 38, maybe I have the 50 fibs, 61.8, or whatever the case may be. With some round numbers, the best possible price will be the area with the most confluence. So just like we saw in the Apex Paragon course, the level with the most confluence could be support, resistance, trend line, moving average, fib, psychological level, and so on and so forth. Okay, most of the time that area of confluence, okay, will be your best possible price. So if here we have 3-4 elements of confluence, and on the lower level, if we're looking for a long, we have only 1 or 2 level of confluence, then in that case this level would be the best possible price. Okay, so it's not always the furthest price, but sometimes what happens is there's multiple levels of confluence. There's the first level, and then there's the second level of confluence. So maybe instead here, if you have 3-4 elements of confluence at this level here, and let's say on the lower level you also have 3-4 elements of confluence, so both levels are valid, okay, at this level as well. Okay, but most traders, when the price reaches the first price, there's a better price underneath it. Maybe it's 30, 40, 50 pips away from the first level, but when we get a reaction on this level, most traders are going to be impatient. They are going to rush in the trade, and they will open a position here in hope that the market bounces from the first level and goes on. Okay, but most of the time what ends up happening is if you enter on the first level and you don't wait for the best possible price, okay, you run the risk of the market pushing below, taking you out, going to the best possible price, okay, that the algos from, in the different institutions are going to calculate the best possible price. They're going to reach that level to enter their best possible position, because of course they want the best possible price for their trading. And basically it's going to reach that second level, that best possible price, and then react and basically have the movement, okay? So basically your whole idea that you wanted to long is good, okay? But if you enter on the first level, that means your execution is bad, and at the end of the day you did lose the trade, okay? You lost the trade, okay? So it's always better to wait for the best possible price or just not enter the trade, because sometimes, yes, you're gonna reach the first level, and depending on the context, it might just bounce back and go from there. And if you waited for the trade at the second level, at the best possible price, well, you're gonna say, Sami, I did not enter the trade, I missed the trade. Well, that's all right, that's okay. I prefer to miss the trade than to run the risk of entering here, getting stopped out, okay, and then basically the market bouncing right after, and basically my idea was good, my execution was bad, and now maybe I'm trying to revenge trade and try to enter the middle of the movement, and then I have a small retracement, I get stopped out again, and I end up with 2-3 losses on this trade, even if my original idea was great. Okay, so just to skip this whole negative process, this whole negative basically process, we want to always wait for the best possible price. Okay, and the best possible price, one last time, is not the furthest price, the technical level that is the most away, okay, the most deep, the most cheap level you can enter your trade. It's going to be the level with the most confluence. Okay, always the most confluence. But if you have multiple levels with confluence, you're going to select always the last level, the second level, or sometimes there's even a third level. Okay, so that's very, very important, and it must be in your trading journal, it must be in your trading rules, it must be in your trading plan. This is very, very important. It's going to save you so many stop losses. Okay. Consistency and endurance. Learn to replicate good market behavior week after week, month after month, year after year. So just like I talked previously in the first part of the psychology, endurance and consistency is very important. Okay, if you're working out, if you're on diet, you have to be consistent. You have to basically keep that diet forever, on the long term, for months and years, if you want to still be in shape and still perform greatly at the gym. Same thing in trading. You have to learn how to develop good habits, good behavior, always wait for the best possible price, and all the other stuff that we saw before. And you have to replicate that good behavior forever in your trading. Okay, not just 1 month, not just 2 months, not just 3 days, not just 1 week, forever. Okay, so you have to find a system to be able to replicate and to motivate you and to keep yourself in check to replicate that good market behavior. Okay, so that's why it's important also to have a trading journal. I discussed this trading journal in the Apex Paragon course. Okay, so you can go back there if you want more detail, but having a trading journal where you write your trades, your behavior, how you're feeling, your performance at the end of the week, your trading performance, and see if you should take a week off, you should take 2 weeks off, a month off. You should basically maybe if everything is going good, then you may want to reward yourself and basically keep going, and you see you're consistent and on track. That's good as well. So negative or positive, in your trading journal you should note everything and then make a system that keeps yourself in check, accountable for your behavior. And the goal is to be, like I said, consistent and have that last for a long term, for a long time, in the long term, and basically just be sharp in your trading and sharp in your psychology forever. Okay. And then lastly, this one is also very, very important, and I see a lot of traders not doing this. So you might recognize yourself if you don't apply this in your trading. Okay, so don't hesitate exiting bad trades in advance, and surely don't hesitate to take some profits of the market even before you take profit. Okay, so partial profits, closing the trade in advance, withdrawals, and so on and so forth. Okay, so let's start with the bad trades. Sometimes you know when you are in a bad trade. Okay, don't let the trade run until your stop loss if you know that the trade is already bad. Okay, so let's say you wanted to short at this level. Okay, market is coming up, we have a rejection, we have another rejection, you decide to enter the trade here. Okay, you're looking for a short, and then the market just basically goes a little bit below, and let's say your stop loss was here. So market goes a bit below and it just starts to consolidate like this. Okay, at this point, okay, in this area, you know that your trade is probably not very good. Okay, we bounced off the support here, we did not make a lower low. You look at the price action, this is suspicious, this is consolidating, break even or minus 5 pips, 10 pips. My stop loss, let's say it's minus 50 pips. Okay, let's just say, why would I wait for the market to basically push and take me out when I know in advance that the reaction and the price action after my entry is not good? Okay, so instead of waiting and just hoping that the market just turns and goes down, which is statistically unlikely if you consider the price action, I'm not gonna wait for the stop loss to be hit. I'm gonna close the trade right now, and instead of having a loss of minus 50 pips, okay, I'm gonna have a minus 10 pips, okay, which is basically 80% saved on my stop loss, only 20% of my loss that I took that I took the hit. And of course, this is going to allow my trading to be a lot better. My statistics are going to perform better. Okay, so don't wait for the trade to touch your stop loss once you know it's a bad trade or you find it suspicious. Okay, and same thing with the profits. Okay, if market is moving nicely, so let's say same example, you want to short here, market comes up, decide to enter the trades. Okay, and let's say you put your take profit here. Okay, stop loss above, and market is trending down, it's nice. Okay, and you get near, you take profit, and it starts to just consolidate like this. Okay, don't wait for the market to reach the take profit at that point. Okay, exit out of the trade before, no worries. If you have a good risk reward, even if you exit at 50, 60, 70, 80% of the way, you're still gonna be in a very positive risk reward over 2, over 3, and you're gonna be able to secure those profits. Okay, so basically, if the markets and the price action is starting to become suspicious, starts having a consolidation, or basically some fundamental event is coming up, I'm just going to exit the trade. I'm not going to wait exactly for the market to touch my take profit, because most of the time the traders are going to wait and market is going to maybe come back here and maybe eventually going to come back. But if you put your stop loss to break even, you got stopped out break even, and you did not take advantage of the profit at this point. Okay, so don't be greedy, don't be too stubborn regarding that. For your stop loss, get out early if the trade is not good, and for your take profit, get out early if you feel that the price action is becoming suspicious. Okay, you can also take partial profits if you want. Okay, like we talked in a few examples that we did before. Okay, and of course you should do withdrawals in your trading. Okay, if you're having a good week and you made maybe 5, 10, 15, 20% of your account, whatever the monetary amount that equals to, you should withdraw a bit of money and treat yourself. Okay, you should pull out money out of the market, you should pay yourself. Don't leave all the money in the market always. Okay, take the habit of pulling money out of the market. That's very important, and also psychologically it's going to reward you. Okay, it's going to create a positive feedback loop of rewarding yourself, because now you've made a withdrawal. Maybe it's only $500, $1,000, $1,000. Already said $1,000. So let's say $5,000, $10,000, $15,000, $100,000. Doesn't matter the amount, okay? Big, small, whatever your trading account size is, you withdraw is going to differ. But with that money that you're gonna withdraw, use it to treat yourself. Go on a nice date with your wife, with your girlfriend. Go on a nice restaurant, book a trip, pay yourself, a massage, whatever. Buy some new clothes, pay some debts, help your parents, help your sister, help your brother. Do whatever you want to with that money, okay? But just make sure that you take something that was made virtually, okay? Trading is virtual. You're playing with numbers and charts all day. Make sure that when you make, good trades, good profit, good growth on your account, you should withdraw a bit of that money and use it in the real physical world to make the connection between the virtual and the physical. Okay, so basically that's my point. Okay. So all of these elements are very important, but I would say the third one here, to close the trade a bit early and basically just to be a bit more dynamic in your trade management and how you perceive the trade, it's going to make a big difference in your trading.